Hey, I'm Nat. I'm a management consultant here based in London, so I spend a lot of my time at work looking at companies and helping investors buy them. So today I'm going to be looking at Netflix stock, a company I think is a really great company. I've been looking at it for quite a while, and if you can get it at the right price, I think it will be a really good investment. Now is a really interesting time because the stock market is falling, so a lot of really great companies are becoming really cheap. So in this video, I'm going to go into that a little bit. I'm going to explain why Netflix is a great company, and I'm going to look at what share price I'd be buying the stock. So the stock market has declined by about 20% since the start of the year, and I think there's still quite a bit left in the drop, and so do a lot of big name investors. So in October, Jamie Dimon, CEO of JP Morgan, said the market could drop another 20 to 30%. Michael Burry, the guy who predicted the financial crisis, reckons the market still has a lot less to drop. And Jim Chanos, the investor that exposed Enron, reckons the S&P could fall to around 1,800 to 3,000, so anything up to around another 60% fall. So yes, I have been rattling on about a big market crash for the last year or two, but now it really seems to be kicking off. I think now you really need to just be doing the prep so that when it does come, you find these really good companies at really low prices. So one opportunity I see is Netflix. I think it's a really great company, and I think it comes down to 4 key reasons. Number one, its market is pretty resilient. And what I mean by that is, so during a downturn, people aren't going to be spending loads of money doing lots of experiences, going to the cinema. They're probably going to save their money and stay at home watching films instead. Number two, I think it's got a really strong competitive advantage within its industry. It's clearly the market leader at the moment with over 200 million subscribers, with Amazon and Disney Plus trailing just behind, and then you've got lots of smaller players. And there are 3 reasons why I think it should stay at the top of its competition. And I think this comes down to its vast array of content. Its library has around 17,000 titles globally. The only other player that compares to that is Amazon, which has a similar number, and then all the other players has a lot less. The second reason why is because it's now attracting some of the best content makers, because it's making Emmy award-winning shows. And lastly, on the reasons why it should maintain this competitive advantage is because of its customer data. So Netflix now knows so much about its customers that it can make content that it knows you're going to watch, and it can feed that to its customers. And one really interesting thing I heard a while back is Netflix actually changes the icon picture that it shows depending on who it's showing it to. So if it knows that you like a certain actor, it will show you that actor as opposed to other stars in the show. So back to the reasons why Netflix is a great company. The third reason is because it has such a strong business model. So it makes a lot of content, it depreciates that over time, and then once they have depreciated that, once the cost has come out of the business, they then continue to make money off of that content. And Netflix has now started becoming really profitable. It's now making around 20% margins, and it could even go higher. Now, I don't think it's going to push to be more profitable because it would have to stop making content, but if it wanted to, it could just sit on all of the content it has and become really, really profitable. And lastly, this is the really key one for Netflix. It still has a lot of potential growth. Netflix has grown its revenue on average at 25% year on year, and its subscribers at 22% year on year for the last 10 years, which is pretty crazy. And yes, they're now at a size where people are saying they can't possibly grow anymore, but I still think there's a lot of room for growth. So in subscriber growth, there's other markets. There's places like India where they're trying to expand into. There's other emerging markets. Another way you can grow subscribers is just by cracking down on account sharing. I know so many people that just have their family accounts, and I have been asking people, if you were to lose that ability to share your account, would you subscribe? And a lot of people say yes because they're just so locked in. Another way that Netflix can grow is by raising prices, and they have shown that they can do this recently with continuous price rises over the last 10 years. The reason why I think they can continue to raise them is because just look at other TV services which historically have been so expensive, up to £50 for a Sky subscription. Netflix is only around £10 for a standard subscription. And the other way it can get more revenue is by ads, and they've actually started doing this. So all of these reasons make Netflix a really great company, but that does not mean that you should go and buy the stock no matter what, because stocks can be really overpriced. Rarely does price equal value. So I'm going to walk through some really simple calculations to put a price on Netflix. So firstly, I take the net income, which was around $5.1 billion in 2021, and is coming in at around the same amount this year. Then I divide by the number of shares to find the earnings per share, and this comes in at around $11. Now comes a really key assumption, and that is the future growth rate. And I get to this by looking at a few things. So historically, revenue has grown at around 25% year on year, and net income has grown at around 37% year on year. Now, because I think profit margins are going to stay around the 20% mark, I don't think they're going to get more profitable, I'd grow mostly with revenue, and this has historically been spurred by 22% subscriber growth year on year and around 6 to 7% price growth. So going forward, I'm going to take a fairly conservative growth rate of 13%. So this is around half the historic growth rate, but yes, we're going to slow down, we're getting big, we can't grow that much anymore. But what this will be made up of is around 7% subscriber growth, so a considerable slowdown on 22% historically, and then a 6% price growth. And this is a little bit slower than it has historically, but I think these assumptions are reasonable, because if we just look at what that means, in 10 years, the subscriber numbers will be around 4 to 450 million. It's not that out of reach, it's not ridiculous. And then the price would grow from, at least in the UK, from £11 to £20. And in 10 years time, that's also not massive. So we have the 13% growth rate, and what we do is then grow that $11 by 30% year on year, and that gets us to a $38 earnings per share in 10 years time. We then multiply the earnings per share by a PE ratio. This is the price over earnings ratio. I'm going to take 26 because it's double the growth rate, but it also happens to be the current PE ratio. So we multiply by 26 and we get to a price of $1,000. So it's important to note that that is the future price in 10 years time. So we don't want to buy it at $1,000 today, otherwise we'd get no returns. We'd actually lose money due to inflation. So we want to come back to today's price with a minimal acceptable rate of return. And I'm going to take 15% as the minimum return I'd want to get from doing this, because if I'm not going to get more than 8%, I might as well just put my money into a stock market fund and just let it sit there. So if I pull that $1,000 back by 10 years at 15% per year, that brings it down to $250 today is the fair price of the company. So this is the fair value or the intrinsic value of the company, but I would never buy it at this price. And this is because you should buy with a margin of safety. Now, this is a term that the legendary pioneering investor Benjamin Graham coined. And what this means is you buy it at, say, 50% of the price so that you are bound to make a profit. So if we take that 50% of the $250, that means our margin of safety price is $125. And so this is the price that I'd probably be buying the stock at. Now, yes, this is really sensitive to different assumptions. So if I raise that 13%, this price can go up considerably. And if I lowered it, it could also drop a lot. So that's why you have to be really solid on your assumptions. And this $125 is not far off from where we saw it drop in May. We saw the stock price fall to around 165 at the lowest point. So not that far off. And actually at this time, I did buy a bit of stock. I only bought around £1,000 of stock. And the reason I did this is because once your company is dropping to near your price, you should sort of get more of a feel of the company and test your emotions. So by buying a bit of stock, you test yourself. And this was quite a good test because it then rebounded. It went up around 20% and I caved and sold the stock. It was kind of stupid because it then continued to rise. So I think it's really important to consider the flip side too. You've got to consider things like Netflix losing its competitive advantage to players like Amazon or Apple who have a lot of money to spend. Or the industry is impacted by other emerging social media platforms like TikTok or YouTube. A lot of young people are going on those these days and have shorter attention spans, so maybe Netflix won't be big in the future. The key thing is you need to do your research and be really comfortable behind your assumptions so that you know that if things do change, you can act on it. So definitely don't just take what I said as gospel. It's definitely not investing advice, it's completely my opinions. But having said that, if I see the Netflix stock fall to these kind of levels, I'm going to be loading up thousands of pounds worth of this stock. Thanks for watching, post your comments below, and see you soon for some more investing and business related content.